All right, let's talk taxes, specifically Canadian taxes. But let's forget all the confusing forms, all the boring jargon. We're going to dive into some surprisingly simple, and I mean 100% legal strategies to help you keep more of your hard-earned money right where it belongs, in your pocket.
I mean, just let that sink in for a second. Most of us are overpaying, and odds are you might be one of them. Look, this isn't about cheating the system, not at all. It's just about not knowing the rules of the game, rules the government itself actually set up.
And that's the big question, right? What if you could just pay less, legally? This is not about finding some sketchy gray area loophole. Nope, it's about using the exact tools the government has given us. The trick is, you just got to know they exist. Okay, so first things first, we have to blow up the single biggest myth about Canadian taxes. I actually had a friend, no joke, who worried that getting a pay raise would mean he'd take home less money. It sounds crazy, but it's such a common fear, and it's completely, totally wrong. Understanding why is, well, it's the key to absolutely everything. Here's the secret, and it's not even a secret. Canada uses what are called marginal tax rates. So what does that even mean? It means when you get a raise that pushes you into a higher tax bracket, it's only the new money, the dollars you earn inside that new bracket, that gets taxed at the higher rate. All your previous income, still taxed at those nice lower rates. I'll say it again. You will never take home less money just by earning more, period. And to make this super clear, let's use a simple analogy. Just picture a row of piggy banks, okay? Each one of these piggy banks is a different tax bracket. So, as you earn money all year long, you start filling up that first piggy bank. Clink, clink, clink. Once it's full, you just move on to the next one, and then the next. And here's the thing. Each piggy bank has its own separate tax rate, starting with the lowest one. You never, ever go back and change the tax rate on a piggy bank that's already full. It's locked in.
Okay, let's look at this with some real numbers. Let's say you earn 70 grand in BC. Your entire $70,000 salary is not taxed at that high 28% rate. No way. Only the last little bit is. You can see it right here. That first big chunk, your first piggy bank, is taxed at 20%. The next one at 22%. And only the very last dollars you earn get that 28% rate. Getting this concept? I'm telling you, it's the foundation for all smart tax planning.
All right, so now that you get how you're taxed, the next step is protecting that income. And believe it or not, the government has created some seriously powerful tools to help you do just that. Let's call these your tax-saving heavy hitters. We're talking about special accounts designed to help you save for the big stuff in life. For retirement, you've got the classic RRSP. And for that first home, well, there's the newer and frankly incredibly powerful FHSA. The beautiful thing about both, they can give you an immediate tax deduction. So how do these two stack up against each other? Well, they're both amazing because every single dollar you put in gives you a tax deduction right away. But, and this is a big but, here's the key difference. The absolute magic of the HFSA is that when you pull the money out for a home, it's completely tax-free. With an RRSP, you're going to pay tax on it eventually when you withdraw. Now, you can borrow from your RRSP for a home, that's the home buyer's plan, but you have to pay every cent back into the RRSP. Okay, moving on from the big registered accounts, there are also smarter ways to handle your everyday money moves. And a perfect example of this is charitable giving. I mean, you're already doing a good thing, so let's make sure you're getting the absolute maximum tax benefit for it, right? So, here's how it works. The federal government gives you a tax credit for your donations, but on the first $200 you donate in a year, you only get a 14% credit. I mean, it's a nice start, but that's not where the real power is. But check this out. For every single dollar you donate above that first 200, the federal credit more than doubles to a whopping 29%. And it can go even higher if you're a high-income earner. So the whole strategy, the whole game, is to get past that initial $200 threshold as fast as you possibly can. So how do you do that? Well, there's a brilliant, incredibly simple strategy that literally anyone with a spouse or common law partner can use. It's so easy. Okay, so instead of you and your partner both claiming your donations separately and you both having to get past that first $200 at the low rate, you just pool it all together. That's it. Claim all the family donations on just one person's tax return. That way, you only get hit with that measly 14% rate once, and the rest of your combined donations, bam, they immediately get that much more valuable 29% credit. It's a simple change on your tax form that can save you real cash. All right, now let's switch gears. For those of you who are investors, and I'm talking about investments outside of an RRSP or a TFSA, things get even more interesting. If you have a non-registered investment account, you need to know about this. It's a powerful strategy called tax loss harvesting.
Here's the basic idea. Let's say one of your investments is down. You can sell it to officially realize that loss on paper. Then you use that capital loss to cancel out the capital gains you made from your winning investments. It just wipes them out, tax-wise. But the final step is absolutely critical. You immediately take that cash and reinvest it into a similar but not identical investment. That way, you stay in the market and you don't miss out on a potential rebound.
But you knew there'd be a catch, right? There's one huge rule you have to follow. It's called the superficial loss rule. And look, the CRA is not dumb. They won't let you sell a stock to claim that sweet tax loss and then just buy it right back 5 minutes later. You, or even your spouse, have to wait a full 30 days. And that is exactly why that third step, reinvesting in something similar but not identical, is so important.
Okay, let's wrap up with one for all the entrepreneurs and small business owners out there. This last strategy is a potential game changer, and honestly, it's often hiding in plain sight. It's the Scientific Research and Experimental Development Tax Credit, or what everyone just calls SR&D. That's SR&ED.
So when I say research and development, what do you picture? Probably someone in a lab coat, right? A scientist with bubbling beakers and test tubes. And I'm telling you, that is the single biggest misconception about this entire program. The reality, SR&D applies to a huge range of industries. It could be a manufacturing shop trying to figure out a faster way to build something. It could be a software company writing a new algorithm. It could even be a craft brewery trying out a new fermentation process. Seriously, if you are trying to solve a technical problem to improve your product or your process, there's a good chance you're doing eligible work and you don't even know it. This here shows you exactly what the CRA is looking for. And yeah, it covers pure basic research, sure. But I want you to look really closely at that last one, experimental development. This is the big one for most businesses. This is the work you do to create something new, or even just make small step-by-step improvements to your products or your internal processes.
So, when you boil it all down, what I really hope you take away from all this is that tax planning isn't about finding some secret, hidden formula. It's about strategy. It's about knowing the rules of the game and using the exact tools the government has created, tools designed to encourage you to save, to innovate, and to be generous. So whether it's finally understanding your marginal tax rate, opening that FHSA, pooling your donations with your partner, or maybe exploring some of those business credits, these are all real, actionable strategies you can use. The only question left is, which move are you going to make this tax season?